Well, welcome to 2024, everybody. I hope you had a good festive season and hopefully this is going to be a prosperous new year. There's a lot going on, and I think one of the big questions out there is clearly, can the Fed actually engineer a soft landing? It seems to be a pretty popular narrative at the moment. So let's sort of delve a little bit more into that. So since early 2022, the Fed has been using higher rates basically to try and cool this economy down. They got inflation slightly getting out of hand, and so we saw quite a big move up to sort of 525, 550 area for the Fed. This what we did see though in December was their last meeting, where Chairman Powell actually did what we call a dovish pivot. So he moved from a hawkish bias to a more dovish bias. In that means suggesting that interest rates could start coming down. And as we can see here on the chart on the right, US inflation pressures have been coming off quite quickly, actually. The core numbers drifting as well, which is what the focus is at the Fed. But this is the easy bit. The question is going to be whether we can actually get them down to target of 2%. But last Wednesday, Fed minutes seemed to confirm that policymakers have acknowledged rates have likely peaked. But the big question here is whether they start cutting early or later. And, why have we seen this shift in the approach from the Fed? Well, they're definitely trying to engineer a soft landing for the economy. So they want to bring interest rates down slowly so that they don't hit growth too hard. And the Fed feel they have curbed the demand sufficiently at the moment and brought inflation closer to its 2% target. On that basis, they have succeeded, but they don't want to cause a significant economic downturn or a big rise in unemployment. So slowly, but getting this balance right is not going to be easy at all. There's quite a lot to be done. It's very rare for the Fed to engineer a soft landing. So the consensus view right now from many economists is that the Fed can engineer this rare soft landing, if you like. And since late October, we've seen traders adjust quite quickly to that. We saw US yields coming off, but we saw the US 500 rally for straight nine weeks on the trot, literally on the back of this hope that interest rates are coming down. They haven't come off yet, but there is a very heavy suggestion that they could be falling. So, we did see a bit of a drop, as you can see here on the chart on the left, of 1.5% last week, but we are reversing that a little bit quietly this week as well. But a lot depends on how the Fed is going to react at the next meeting, and certainly the one into March. So swaps at the moment, what we call market pricing, if you like, is suggesting that we are still looking at a potential March cut. Now, some people may suggest that's a little too early, looking at the resilient and fairly strong data. But if we look at the Fed forecast against the services data, the services data is holding up pretty well, to be honest, but the Fed forecast is beginning to come off quite a lot. There is a big question about whether the Fed actually needs to cut as early as March. And I think, would the Fed need to cut rates as aggressively as market expects is one of the biggest questions out there at the moment. So here we are. Looking back at week 1 of 2024, just to get the whole thing started, employment data was actually generally better in the headline basis. We saw ADP private payrolls better. We saw initial jobless claims falling, which is a positive and a very good indicator because it's weekly. And we saw headline data in non-farm payrolls increase. Now, within that, we also saw wages grow, which initially sent yields higher and the dollar higher, as you're aware. But we can see here on the chart that how solid that data was. On the left-hand side, US employers added more jobs than expected across the board, really. And that rise in wages made many people think that maybe March is too soon for a cut. But we saw service activity, the ISM services or non-manufacturing, fall back towards close just to above 50. Now, this 50 level is the cutoff between expansion and contraction. And on that, I think the market got a bit nervous again that they may have to start cutting, because if we look at the structure of the US economy, the bedrock of that at the moment is services and services spending by consumers. That has been holding up the US economy, and the fact that that is starting to come off, I think, is a bit of a concern. So what could all this mean for stock indices and the dollar across the rest of January? Very good question, that, because I think there is some real questions and some real differing ideas about where we're going to go from here.